Dear students, welcome to the lecture series on financial accounting. In today's lecture, we shall take up Unit 9. Under Unit 9, we will learn in detail partnership accounts. In partnership accounts, we have to learn today about the reconstitution of the firms. And in the reconstitution of the firm, first of all, we will learn about admission of partner. When we talk about reconstitution of the firm, it means change in the already going business organization. That is, whatever is the composition of the partnership firm which is there to carry on the business, it has changed. It is changed either due to admission of a partner or due to retirement of a partner or due to sudden death of a partner. So, there are various circumstances under which reconstitution of the firms takes place. So, first of all, we will learn in detail about admission of a partner. When a new partner comes into the business organization, so there is a change in composition. We have to deal with many accounting aspects. Among it, first of all, which we have to learn in detail is treatment of goodwill. In our previous lectures, we have learned already the valuation of goodwill, which is to be done by following either of the three methods, that is average profit methods, super profit methods and capitalization method. So, once we have valued the goodwill, now it is the time to treat this goodwill into the books of the firm at the time of admission of a new partner. So, we will learn in detail various situations and scenarios under which goodwill has to be treated in the books of the firm when a new partner comes into existence in a business organization. Now, as we were talking that we have to treat the goodwill into the books of accounts at the time of admission of partner. Now, we have to do certain adjustments in the books of the accounts depending upon the transaction which has entered into by the new partner with the old partners. So, as per the agreement between the old and new partner, this treatment varies. Generally, what happens that either the goodwill is brought into cash by the new partner or it is not brought into cash. So, how the goodwill is to be treated, how the already existing goodwill has to be dealt in, we have to learn in detail. So, we have to do the adjustments of goodwill. The new partners gets a share in the profit of the firm. He should compensate the old partners for sharing earnings of the firm on account of reputation or goodwill earned by the partnership firm so far. The new partner compensates them by making payment in cash or in kind. The payment is equal to his or her share in the goodwill. So, when the new partner gives in cash or kind the share of the goodwill, it is to be dealt in the books of accounts. As per Accounting Standard 10, which is known as AS 10, that goodwill should be recorded in the books only when some consideration in money has been paid for it. Thus, if a new partner does not bring necessary cash for goodwill, no goodwill account can be raised in the books. The new partner should pay for goodwill in addition to his contribution to the capital. So, taking the AS 10 into light, we can say that as and when the new partner brings his share of the goodwill in cash, at that time only the goodwill is to be recognized in the books of accounts. So, when a new partner comes into the business, he has to bring his contribution both in terms of goodwill as well as his contribution towards capital. Now, let us analyze the situations which can occur when a new partner brings his share of contribution. So, the problem of goodwill on admission of new partner can be dealt in three different ways. The first one is when the amount of goodwill is paid privately by the new partner. Second situation is when the new partner brings his or her share of goodwill in cash. And the third and the last situation is where when the new partner does not bring his or her share of goodwill in cash. So, we are having the three situations into our hand. One is a private transaction between the new partner who is being admitted into the partnership firm with the old partners. So, in all, it is not a business transaction. So, let us see how the partnership firm is going to enter this accounting transaction in the books of accounts. The second aspect, which is saying that he has brought his share of the goodwill in cash. So, we have to dealt with the accounting entries when cash is to be entered into, goodwill has to be distributed among the existing partner, and how the treatment of goodwill is to be done in the capital accounts of the partners. And the third scenario is where the amount of goodwill is not brought into cash. So, we have to do the adjustments into the capital account of the existing and new partners as in the light of AS 10, when the cash is not brought in relation to the goodwill or in relation to the share of the goodwill of the new partner, we are not required to show the goodwill account in the books of accounts. So, we will take up these situations one by one and analyze them in detail. The first one is the amount of goodwill is paid privately by the new partner. If the amount of goodwill is paid by the new partner to the existing partners privately, no journal entries are made in the books of the firm, because it is not a business transaction, and any business organization shall record the transactions which are having the business value and economic value in the books of accounts. So, any private transaction need not to be recorded. The second one is the new partner brings his or her share of goodwill in cash, and the amount of goodwill is retained in the business. So, we are having a scenario where such share of goodwill is being brought, and that is brought in cash, and such goodwill amount is retained into the business. So, let us see how the transaction will be recorded in the books of firm. The amount brought in by the new partner is transferred to the existing partners in the sacrifice ratio. If there is any goodwill account in the balance sheet of the existing partner, it will be written off immediately in the existing ratio among the partner. When we analyze this accounting transaction, we can ascertain that the new partner has brought the money, and that amount is to be transferred to the existing partner's capital account in the sacrifice ratio. Sacrifice ratio is the ratio which is difference between the new and the old ratios. It is the share which is being sacrificed by the old partners to give a share into the profit to the new partner. So, as per the agreement between the new partner and the existing partners, we have to find out the sacrificing ratio. Then this sacrificing ratio is to be used to distribute the amount of the share of the goodwill of this new partner to be distributed among the existing partners. If there is any goodwill account in the balance sheet, that means if any existing goodwill is there into the balance sheet of the firm, it has to be written off in the previous ratio in which the existing partners were sharing the profits and losses. So, we will learn in detail the accounting entries, that how this transaction is to be recorded in the books of accounts. Let us see these journal entries. First one is when the goodwill is to be written off. So, existing partners account debit to goodwill account. Being goodwill written off, it is the goodwill which is already appearing in the balance sheet. So, we have written it off in the existing profit sharing ratio. Now, the next entry is relation to the bringing cash for capital and goodwill. So, the journal entry is cash or bank. It can be cash or bank depending upon the mode of the payment which the new partner has opted. So, cash or bank debit to goodwill to new partner's capital. Here to goodwill will show the amount of the goodwill, and to new partner's capital will show the contribution which he has made in relation to his capital. Now, the next entry which we are going to pass is for the amount of goodwill transferred to the existing partner's capital account. So, the portion of the goodwill which is being brought in cash by the new partner, this has to be shared with the old partners in sacrifice ratio. So, goodwill account debit to existing partners capital account, and the amount will be shown individually for each partner in their sacrificing ratio. For example, there are two partners and sacrificing ratio has come equal, that is 1:1, and the share of the goodwill of the new partner is 5,000. So, both the partners, that is A and B, would be credited as to A 2,500 and to B 2,500, and goodwill will stand as 5,000 as the debit amount. So, we have to ascertain the sacrificing ratio in the said manner. Old ratio minus new ratio is equal to sacrifice ratio. This sacrifice ratio is to be computed in order to distribute the amount of the goodwill so brought by the new partner to be distributed in the existing partner's capital accounts. So, we have to ascertain this sacrificing ratio so that the appropriate amount of the goodwill can be distributed amongst the existing partner in this sacrificing ratio so determined by us. So, while solving the question, first of all we have to ascertain the sacrifice ratio in the form of the working notes. Once this sacrificing ratio is being ascertained, we can distribute the goodwill so brought by the new partner into the existing partner's capital account and can go ahead and solve our question in relation to the admission of the partner. Students, now a question comes into our mind that how we will do these journal entries in the practical scenario. So, we will take up a question and analyze these entries. First one is A and B are sharing profits in the ratio of 5:3. They admit a new partner C with 1/4 share in the profit. C brings cash rupees 30,000 for her share of goodwill and 1,20,000 for capital. Make journal entries in the books of the firm and the new ratio is 2:1:1. So, we are being furnished with so many information in the question. So, when doing the accounting in relation to the goodwill, we have to find out the trigger point. Here the trigger point is that C, the new partner, has brought the cash of 30,000 for the share of goodwill. So, goodwill is brought in cash. So, we have to do the journal entries in the first scenario where goodwill is brought into cash by the new partner. So, let us move ahead and solve this question. So, first of all we will prepare a working note where we have to find out the sacrificing ratio, because the share of the goodwill which is being brought by the new partner is to be distributed amongst the old partner in the sacrificing ratio. So, one thing is very certain that this sacrificing ratio is to be ascertained for the existing partners. So, here is a table which shows the calculation of the sacrificing ratio. So, first column is showing the name of the partners and they are the existing partners A and B. Their existing ratio as given in the question is 5:3. So, we have written up the existing ratios as 5/8 and 3/8 for B. The new ratio for A and B is 2/4 and 1/4. It is written 2/4 and 1/4 because the new ratio as given in the question is 2:1:1. So, A's share is coming out as 2/4 and B's share is coming as 1/4. Now, we have to ascertain the sacrifice being made by A and B. So, we will find the difference between these two ratios. So, 5/8 minus 2/4 is giving us the fraction of the sacrifice being made. 5/8 minus 2/4 is 1/8 for A, and in the similar fashion we have ascertained the sacrifice of the B and it is coming as 3/8 minus 1/4 and it is also coming as 1/8. So, we have to distribute the goodwill so brought by the new partner amongst the old partner in the ratio of 1:1. So, equal share of the goodwill will be shared by the existing partners. So, let us see the journal entries. First entry is in relation to the share of the contribution which is being brought by the new partner. So, in our question we are being given the information that he has brought rupees 30,000 for the goodwill and rupees 1,20,000 for his share of capital. So, in all the firm has received the bank account or the cash in hand for rupees 1,50,000. So, we will write up bank account debit 1,50,000 to goodwill, and adjacent to goodwill we will write in the credit column 30,000, that is the amount of the goodwill he has brought for his share and this 1,20,000 he has brought for the capital contribution in the partnership firm. So, this is the way first entry in relation to the contribution which is being brought by the C has been accounted for. Now, the next entry is in relation to the goodwill. This is the amount of the goodwill which he has brought into the business. So, goodwill account debit 30,000 to A's capital and to B's capital 15,000. They are divided equally because the sacrificing ratio as has been computed by us is equal. It is 1:1. So, goodwill transfer to the existing partners in the sacrifice ratio and it amounts to 15,000 for each of the partners. Now, a question can come into the minds of the students that can such amount of the goodwill be withdrawn by the existing partners? Yes, it can be withdrawn. The full amount can be withdrawn. Certain percentage can be withdrawn, either 50% or 25% depending upon their need. So, let us see what is the journal entry which we need to pass when there is a withdrawal of the goodwill from the partnership firm by the existing partners. So, here the journal entry is existing partners account debit to cash or bank. The narration which we are going to write is the amount of goodwill withdrawn by the existing partners. It is to be noted that sometimes partners withdraw only 50% or 25% of the amount of goodwill. In such cases, entry will be made for the withdrawn amount only. That is how the withdrawn varies, the amount of the goodwill withdrawn will vary in our journal entry. It is not necessary that we have to write up the full amount of withdrawn. So, one thing which is to be noted is that we have to take care of the percentage of withdrawn while passing this entry. Now, how shall we pass this withdrawn entry in this same example? Let us say this. We will assume that full amount of 30,000 has been withdrawn by A and B. So, its journal entry is A's capital account debit, B's capital account debit. In the debit column, we will have written 15,000 for A and 15,000 for B to bank account 30,000 amount withdrawn by them. As they have withdrawn the full amount, we have shown the full amount being withdrawn, that is rupees 30,000 in the credit column of the journal so prepared. Now, the next scenario is where the new partner does not bring his share or her share of goodwill in cash. So, how the accounting entry will vary? Let us learn it. When the goodwill of the firm is calculated and the new partner is not able to bring his or her share of goodwill in cash, goodwill will be adjusted through the new partner's capital account. In this case, new partner's capital account is debited for his or her share and the existing partner's capital are credited in the sacrificing ratio. So, the role of goodwill is not there. Goodwill account is absolutely not being used and the adjustment shall be made for the amount of the goodwill which is the share of the goodwill of the new partner amongst the new and existing partners using their capital accounts. So, let us see how the journal entry is being passed when the adjustment of the amount of the goodwill which is for the share of the new partner is being adjusted through the partner's capital account when he has not brought the amount of goodwill in cash. So, this entry will flow as new partner's capital account is to be debited and to existing partners capital account is being credited and they are being credited individually in their sacrificing ratio. So, we have to pass this composite and single entry in relation to the adjustment of the goodwill in the books of the account when the amount of goodwill is not brought by the new partner. What happens that it becomes very difficult to find out the appropriate amount. So, for the ease, the students can raise the goodwill in the old ratio and write off the goodwill in the new ratio. So, the net amount of the entry will come same as that of this entry. So, the overall objective of ascertainment of the share of the portion of the goodwill of the new partner is that it is to be adjusted into the partner's capital account into their sacrificing ratio. So, with this we have learned in detail two very important scenarios where we have to find out the treatment of the goodwill to be done in the books of the firm, where the goodwill's amount is brought in cash by the new partner and where the goodwill amount is not being brought in cash by the new partner. So, taking a stand into the light, we have to do the adjustment entries into the capital accounts of the partners where goodwill is not brought in cash. So, we will learn it in detail with the help of our example in our upcoming lecture. With this, we are ending up our lecture of today. In today's lecture, we have learned the treatment of the goodwill in the books of the firm at the admission of a new partner. So, when the reconstitution of the firm takes place, and that too on account of the admission of a new partner, we have to find out the sacrificing ratio, we have to value the goodwill and have to distribute goodwill in the manner the treatment of goodwill is being prescribed under Partnership Act or under the partnership deed, and we have to take into consideration all the accounting treatment of the goodwill, and we have to find out the proper method to account for this goodwill into the books of the accounts as per the transaction which is being entered by the new partner with the old partner.